Hello, everyone. Welcome to today's Elevate Wealth Advisory monthly webinar series. Today, we're going to discuss a year-end checklist and some ideas for year-end financial planning. With December 31st fast approaching, you may want to make sure that you're not only meeting those year-end deadlines, but we're also setting you up to be well prepared heading into 2024. My name is Brian Rosso, and I'm a wealth advisor here at Elevate Wealth Advisory. If you are new to us, we are a wealth advising firm based in Athens, Georgia. We were founded in 1982 by Chuck Vickery as Vickery Financial Services with the goal of helping people make smart decisions with their money. More than 40 years later, we have now grown to a team of 10 and have rebranded to Elevate Wealth Advisory, led by our current president and CEO, Deanne Rosso. Before I introduce you to our speaker, just a few things to note. If you have questions throughout today's presentation, feel free to drop them in either the chat box or the Q&A box. We will hold on to those questions and answer them at the end of the presentation. If for some reason we are unable to answer those questions, we'll make sure to get back to you quickly via email. Now, I'd like to introduce to you our speaker for today, Rob Fezekas. Rob joined the team in Elevate in 2015 as a wealth advisor. He is a graduate of the University of Iowa, where he earned a Bachelor of Arts in Finance and a minor in mathematics. Rob then earned his MBA from the University of Chicago. His investment career began in 1992 as a securities analyst with Principal Financial Group in Des Moines, Iowa, and continued as a portfolio manager with Dimensional Fund Advisors in Santa Monica, California. Here at Elevate, he now strives to provide each client with a customized investment plan and incorporates all aspects of their particular financial situation and goals. Rob, welcome. Thank you for being here, and I'll let you take it away.
Great. Thanks so much, Brian. And good afternoon, everybody. I'm going to be talking about year-end planning today. Let me start by sharing my screen, and then I'm going to turn off my video and see how that works. So hopefully everybody can see that first slide that says year-end planning, changes for 2023 and beyond. Let me turn my video camera off. All right. Great. So I will be talking quite a bit about taxes today. So I want to start with a disclaimer, since I am not a CPA, that the tax strategies that I talk about may or may not apply to your situation. So it's always a good idea to speak with your situation with a professional tax advisor, a CPA, someone who really knows your situation, because again, these strategies are kind of generic and may or may not apply to the situation that you are in. All right, so let's dive right in to year-end planning. And so when I say year-end planning, what am I really talking about? Let's start with a basic definition, which is that year-end planning is a set of action steps that we can take, usually before the end of the year, but not always, and I'll get into that. But action steps that will put ourselves in a better position for next year and beyond. Now, we often think about year-end planning, and certainly here at Elevate, we think about year-end planning in terms of our finances, things that have to do with investments and taxes, income and spending. But it does include other kinds of planning, year-end planning, such as our health and well-being. So I'm going to give you a few examples of items that definitely fall in this category of year-end planning. And a big one that kind of occurs to many people naturally towards the end of the year usually is giving to charity or making non-charitable gifts, maybe to friends or loved ones. So that is something that definitely falls under the year-end planning category. We might want to schedule some voluntary medical checkups, particularly if we've used up our deductible, or maybe we've hit our out-of-pocket limit. You want to get those in by the end of the year. You might be able to save some money that way. If you have a flex spending account, you want to be sure to use up the balances before the deadline. Sometimes those deadlines go beyond December 31st, but often those kind of accounts are use it or lose it. So you definitely want to check those balances and make sure you don't leave anything behind. Depending on the tax brackets that we're in, our income situation, you might want to try to either accelerate income into this year if you happen to be in a low tax bracket, or you might want to try to defer income into next year if you have that ability. If you're in a high tax bracket, maybe trying to save some taxes. You may be able to incur some voluntary or deductible expenses, particularly if you're a business owner. Rebalancing an investment portfolio is another good thing on the checklist of year-end planning. If you haven't been rebalancing throughout the year, probably at least once a year is a good idea to take a look at that and make sure your portfolio hasn't drifted away from the initial targets that you set for yourself. You may have an opportunity for tax loss harvesting. So if you have some capital gains this year, you might have the ability to offset some of those gains with capital losses. I'm actually going to spend a lot of time talking about that strategy. I've got a whole slide, so we will definitely hit that one in more detail. You may want to contribute to a retirement account, a health savings account, or a college savings plan, like a 529 plan. Those are generally annual contribution limits. So if you haven't hit your limit, you might have some room to add some before the end of the year. You might either need to or want to take a distribution from an IRA or other retirement account. If you're above a certain age, you are likely to have a required minimum distribution that you need to take to avoid penalties. So you want to make sure you do that. And you also might want to consider converting part of an IRA to a Roth account. And I will be talking about that as well in more detail. So there's really a lot of things, again, as you're probably starting to realize, that fit in this year-end planning category. So it's a good idea to have a checklist. This is one of many checklists that we like. Your 2023 last chance financial planning checklist here. You can see it's divided into 6 broad categories of planning. I won't be going over, in the interest of time, over each one of these, but I will spend a long time on number 1, which is taxes. And we'll also touch on number 2, number 3, and number 5 through the course of this presentation. Let's see, milestones. So each year we're all getting older, and your age can sometimes trigger a change in sort of your ability to either contribute or withdraw from certain kinds of accounts. The tax laws change for each of us depending on our age. So it's a good idea to check and see if maybe this year you've hit one of these age milestones, because it might impact what you are able to do and sort of changes your tax situation. So starting at age 50, you're allowed to make what they call catch-up contributions to some qualified retirement plans and IRAs. Basically means you're allowed to add more to your retirement account and have those deductible often from your taxable income if you've reached that age milestone of 50. You can take distributions from 401k plan without penalties if you've hit 55, at 59 and a half, same thing for IRAs. You can apply for Social Security benefits early at age 62 or late at 70 or any age in between. But those are kind of the 8 years that you're allowed to apply for Social Security. 65, you become eligible for Medicare. And then at 70 and a half, there is a gifting strategy that becomes available to you if you meet some other requirements. But the age requirement is an important one. That's called a qualified charitable distribution. And we will also talk about that more in depth before the end of the presentation. And at 73, you'll have to begin taking those RMDs from IRAs. That number has changed just from last year due to some new legislation, which I'll also go over. Used to be 72. Before that, it was 70 and a half. And now it's just recently changed to 73 for the age at which RMDs begin. So diving a little deeper here into taxes, some of the things that you might want to do before the end of the year related to taxes and tax planning is certainly project your income for this year and next, so you know what tax bracket you might fall into and what your tax liability might be, and what certain decisions you make how they may impact your final tax bill this year and next. You can look at your investment income. Always want to check for new tax legislation. Things are always changing. It changed again at the end of last year, which I'll talk about. You want to look at your capital gains, realized and unrealized gains and losses, which you'll need cost basis information for. You may have sold an appreciated property, real estate, or other assets that could incur capital gains. You may have capital loss carry forwards from prior years. If you've had some losses, you might be able to use those this year to offset gains. So you want to check for that. Other deductions and credits this year and next. You want to review those. Think about giving to charity, what impact that might have, and any other gifting plan. So again, speaking of taxes, let's take a quick look here at what the federal marginal tax rates are for 2023. You can see on the left side, we've got the actual tax rates. Those numbers, those percentages, they don't change too often. They tend not to change year to year. Usually requires an act of Congress to change those. The last time they changed was in 2017 with the Tax Cuts and Jobs Act, which lowered all of those tax rates by 2 to 3% on average. But those are the tax rates that are in effect for 2023. It's also important to note that that law is slated to expire at the end of 2025. So we have this year, 2024, and 2025 to enjoy these lower tax rates. And unless Congress acts and passes new legislation, the tax rates are expected to revert back to their higher rates, the pre-2017 rates. Again, 2-3% higher across the board. The highest rate at 37 would go to 39.6. And so if nothing changes in 2026, we will have higher tax rates. So something else to keep in mind when you're doing some tax planning, you may want to take advantage of these lower tax rates while we still can. Now, the other numbers here that show the income levels, these are the taxable income levels depending on your filing status and what tax rate applies to each income level. So let's take a quick example. Say you're a single filer and you earn $100,000 in 2023. So you can look down that first column for single filers, and you see that $100,000 of taxable income falls in that 24% bracket, right in the middle, which runs from 95,375 to 182,1. So 100,000 is at that 24% bracket. Now, does that mean that you owe 24% of your income this year? Does that mean your federal tax bill will be $24,000 if you earned 100,000? No, it actually does not mean that, because that 24% only applies to the amount of income over the 95,375. So someone that made $100,000, they would only pay 24% on a few thousand, about $4,600 roughly of their income. The rest of their income would be taxed at those lower rates. So their first 11,000 still gets taxed at 10%, and then the next 34,725 gets taxed at 12%. So it's just important to know how these marginal rates work, and that's how they work. And then, of course, your filing status matters. If you're married or you're a head of household, you have different brackets to keep in mind. So these are the things that we certainly look at when doing tax planning. We also need to be aware that the numbers in those last three columns, they do change each year because they're indexed to inflation. So these numbers are all a little bit higher than 2022, and we expect they'll be higher again in 2024. Each of those brackets, tends to start with higher numbers and grows along with inflation. So again, staying on the theme of taxes, it is always important to keep the primary goal in mind when we're doing tax planning. So a lot of people think, oh, I just want to see what I can do to minimize my taxes this year. How do I get the lowest tax bill for 2023? Are there some deductions or things I can do to lower my income liability? And that might be the right thing to do, but really the goal that we should always be keeping in the back of our minds is we're trying to minimize lifetime taxes. What's your total tax bite over the course of your entire lifetime? Now, sometimes that means minimizing taxes this year, but sometimes it doesn't. Sometimes you're actually better off by paying a little bit more in taxes this year because you'll save a lot in taxes in future years. So you really have to think many, many years ahead when you're deciding, what actions to take when it comes to tax planning. So let's move on from tax planning a little bit and talk about some other forms of year-end planning. And a big one, which I mentioned briefly before, is charitable and non-charitable gifting. Now, this is one of those categories of planning that does have a December 31st deadline, especially if you're going to try to deduct any charitable contributions if you're eligible. Those need to be made by the end of the year. So not all deadlines fall on December 31st, but this is one that does. Let's actually talk about non-charitable gifting first, and we will talk about charitable gifting on the very next slide. So a non-charitable gift is a gift that is not made to a charity, to an IRS-recognized charitable organization. So these are gifts that you might make to friends and family or other individuals. So they are not deductible under the law, but you're still allowed to make them. The gift tax exclusion limit this year is $17,000 per person. Now, there's often a lot of confusion over gift giving, and people wonder if I give $1,000 or $5,000 to my son or daughter, or to a friend, or to my parents, is that going to be taxable income to them? Do they have to pay taxes on it, or do I have to pay taxes on it? Is this gift going to be taxable to me? Now, the answer is very easy for the recipient. Gifts are not considered taxable income to the gift recipient. So they don't have, you can give money away and they don't have to worry about paying taxes on that gift. It's also very unlikely that you will have to pay taxes on a gift unless your gift is extremely large, which we'll get into in just a second. Now, so this gift tax exclusion of 17,000 means, again, that an individual can give up to $17,000 a year to any other individual. That means a married couple could give up to $34,000 away this year to any other person, and they don't have to worry about filing a gift tax return or paying taxes on that gift or anything like that. You're just allowed to do that. So you could actually stand on a street corner and you could hand out $17,000 to every person that walks by, and you'd never have to worry about even filing a gift tax return. There's no problem with doing that. So what if you want to give more than the 17,000? Well, you can. That's also not really a problem. All it means is that we need to account for it. We need to keep track of it. That's what the IRS wants to do. So if you do give a gift larger than the 17,000, or if a married couple gives more than $34,000 to the same person this year, what you need to do is file a form 409, the gift tax return, or sorry, 709, gift tax return. And what that does is the IRS will keep track of that gift, and they will use the amount that was over the 17,000 to reduce your lifetime unified gift and estate tax exclusion amount. This year, that exclusion amount is $12.92 million per person. So it's a very, very large number. Very few people have to worry about that, right? Unless you're giving just enormous gifts away. It's just an accounting method. So again, you could give $100,000 away, and what'll happen is now your estate tax exclusion amount would drop from 12.92 million to 12.82 million. So really not a big deal for most people. Just needs to be tracked, and that's what that form 709 is for. One more thing to keep in mind, though, the Tax Cuts and Jobs Act of 2017 really increased that estate tax exclusion amount. Again, kind of like those marginal tax rates that we talked about before. That large exclusion amount is effectively scheduled to be reduced by quite an amount quite a large amount in 2026. So right now it's almost 13 million, and it's estimated that, again, if nothing changes, that estate tax exclusion amount will drop to about 6.5 million. So still big number, but only about half the size that it is this year. Okay, let's talk about charitable gift giving. So charitable gift giving, these gifts may be tax deductible to you if you itemize deductions and you're over a certain amount. You might be able to reduce your taxes by giving to a 501c3 recognized charitable organization this year. There are some limits. The deduction limit for a cash gift is 60% of your adjusted gross income. You could also give non-cash gifts, such as a appreciated security, if you want to give shares of stock or shares of a mutual fund or maybe a real estate holding. You could give that away. The deduction limit is lower for those kinds of gifts. That's 30% of your adjusted gross income. But it's kind of a double benefit to you, because you get to deduct the full market value of the appreciated security, and you'll never have to worry about paying the capital gains tax on that if you give away an appreciated security. Now, another change from that Tax Cuts and Jobs Act was that the standard deduction amount was dramatically increased. So fewer and fewer people these days are actually itemizing deductions like they used to, because the standard deduction is so high. They're usually better off just claiming the standard deduction. But if you want to try to save taxes, and if you have the ability to do so, you might be able to exceed the standard deduction by bunching more than 1 year's worth of charitable gifts together into a single year. Maybe you give $5,000 a year away, but that's not enough to itemize deductions. But if you did, say, 15,000 or 20,000 this year, 3 or 4 years worth, you may be able to get over that standard deduction hump, and you can itemize deductions this year and actually save some on taxes, and then not give any charitable donations for 3 or 4 years and then go back to bunching. That's one way of doing it. And often that strategy can be used in conjunction with a donor advised fund, which is nice because you can give that donation away, make a very large donation, bundle a few years worth of charitable giving together and put it in a donor advised fund. You still get to take the full market value deduction for that gift this year. But now that it's in a donor advised fund, you can choose the time frame that you want to actually make those charitable gifts. They're called grants from a donor advised fund to the charity. So you can still work on the same time scale as before. You just issue grants, on an annual basis or whatever you want to do, but you still have total control over the timing of those gifts. So those two strategies work nicely together. Another charitable gift giving strategy is the QCD, or Qualified Charitable Distribution, if you're eligible, and I'll talk about that shortly, some of the details about how that works. There's some qualifications for that strategy. If you're eligible, needs to come directly from an IRA, needs to go straight to the charity, not to you first. So you actually never would touch the distribution. Go right to the charity. You have to be over age 70 and a half, and then there's an annual limit of $100,000 that you could use that strategy for. So let's talk more in depth about how that works. Again, $100,000 is the limit. Cannot come from a 401k or a 403b. This has to be from an IRA, goes directly to the charity. And if you are subject to required minimum distributions, if you're over age 72 or 73, you have RMDs, you can count this distribution as an RMD, or count it towards your RMD, which is nice because then you don't actually pay income tax on your RMD. It still satisfies the RMD, but it won't be treated as taxable income. So let me show you how that works and what the difference between a non-QCD contribution, how that looks compared to the QCD. So let's start with a non-QCD charitable contribution as an example. So imagine that you have an IRA. You're subject to required minimum distributions. Maybe you're 73 or 75 years old, and you know that you need to take your RMD, which is $5,000 this year. So that has to come out of your IRA. So you want to take care of it. Maybe it's January. You say, let's go ahead and take care of that RMD. I don't want to have to worry about it. And you ask for your distribution. You get $5,000, and now you're done. Your RMD has been satisfied for the year. Later in the year, you're reviewing your charitable causes. You decide you want to give $5,000 to a charity of your choice. You write them a check, send it to the charity. The charity's happy. They get $5,000. And the total cost, though, of that charitable contribution to you is really $6,200 because you gave away $5,000, but you also had to pay $1,200 in tax, assuming you're in that 24% tax bracket, $5,000 of extra income. Remember, distributions from IRAs are generally considered taxable income at ordinary rates. So you'd have to pay 24% tax on that $5,000, which is $1,200. So to you, the total cost is $6,200 in this scenario. Now let's see what that would look like if you used a QCD distribution. So in this case, instead of requesting a distribution to you from your IRA, you simply request that a distribution be made directly to the charity of your choice. You effectively, you send the $5,000 from your IRA directly to the charity. You never see it. The charity gets $5,000. So to them, this strategy is exactly the same as option one, right? There's no difference. But now your RMD has been satisfied for the year, and the $5,000 is excluded from your taxable income. So you don't pay any tax at all on that $5,000. So now the charitable contribution really just cost you the $5,000 that you gave away. You saved $1,200 in taxes. So you can see this is a pretty powerful tax saving strategy if you're eligible and if you are charitably inclined. Something to look at. Again, if you're over age 70 and a half, this option might be available to you. Now, there's all sorts of ways to kind of manage your tax brackets. And again, it depends on sort of your situation, whether you are maybe in a low tax bracket and you have the ability to recognize some more income this year and have that taxed at favorable low rates, or maybe you are in a very high tax bracket and you're trying to see what you can do to lower your tax bill by either deferring income to a future year or trying to sort of rack up more deductions to lower your tax bill. So it kind of depends on what situation you find yourself in. One way that you can kind of control your income if you're already in a high tax bracket is perhaps you have a Roth account and you might need some more income. You could take it from a Roth if you're eligible over the age of 59 and a half, and you don't have to worry about penalties. And Roth distributions are tax-free, so it's different than an IRA. You can withdraw money from a Roth account and not have to worry about paying taxes, so it won't impact your marginal rates. Conversely, if you find yourself in a low tax bracket, the lowest tax brackets actually have very low rates on capital gains. Actually, if you're in the 10 or 12% federal tax bracket, your capital gains rate's actually 0%. So you might be able to sort of obtain some more income by selling some stock, particularly appreciated stock, this year, if you're in that low bracket, and you may pay no capital gains tax at all, or maybe you're in the 15% capital gains rate. Either way, that could be a more gentle tax bite than paying ordinary income rates. Or again, if you're in a low bracket, you might decide to take more from an IRA or 401k because you're in that 10% or 12%, maybe 22% tax bracket. You want to take advantage of that while those brackets are still in effect and while your income is otherwise low. And that might save taxes in future years when tax rates are higher, or if you expect your income to be higher. So one more strategy to consider is a Roth conversion. That basically involves taking part or all of an IRA account and converting it into a Roth account. Now, it's important to know that that is a taxable event. So when you convert some or all of an IRA to a Roth IRA, the amount of the conversion is generally considered taxable income. So you certainly want to be careful with this strategy, and you don't want to end up with a surprise, large tax bill because you made a big conversion. Of course, once it's in the Roth account, then the money grows tax-free and distributions are tax-free. So they're nice to have as an option for income, particularly after you're retired, and then you don't have to worry about paying taxes on it. So it's often a good strategy to look for a year in which your income happens to be low. Maybe you've just retired, and maybe you haven't applied for Social Security yet, or maybe you haven't reached R&D age yet, or you're a business owner with maybe you've got large losses this year instead of gains, and you find yourself, for whatever reason, in a year where your income is very low. These can often be good years to make a Roth conversion because they'll be usually taxed at a lower rate. So it's a good time to maybe convert some IRA money into Roth money, and then not have to worry about paying taxes on that money in the future. Another strategy that goes right along with a Roth conversion is what they call filling up the bracket. So let's take an example of maybe a married couple who are in the 22% bracket. I think the 22% bracket for married couples this year runs from approximately 90,000 to 190,000 in taxable income. Let's say you have taxable income of 140,000. So you're kind of right in the middle of that 22% bracket this year. So one option for you is you could decide to take some more income this year in the form of a Roth conversion, because you know that about $50,000 anyway will still be taxed at that 22% because you've got so much room above your taxable income of 140. You could go up to as high as 190, and all that income will still be taxed at 22%. So some people do this. They look at their tax situation towards the end of the year and they say, I've actually got some room to recognize more income because I'm right in the middle of that 22% bracket, or maybe the 12% bracket. Maybe I can just strategize and do a Roth conversion of a certain size that will take me right up to the top of that bracket, get full advantage of these lower rates. So that can be another tax saving strategy to think about. Couple more things. This stuff definitely gets complicated because it's not just federal income tax rates and income tax that we need to worry about. There are some tax traps to be aware of when we decide to recognize additional income. The first one that I'll talk about here is the Medicare IRMA bracket. So if you're over 65 and if you are on Medicare, you probably know that what you pay each year for Medicare depends on your income. So people that make a lot of income, they actually pay more for the same Medicare coverage. If you're in a low income bracket, you tend to pay less for Medicare. So these are the brackets that are in effect for this year. Now you'll notice it says 2023 IRMA brackets there at the top of the chart, and then right under that line it says 2021 MAGI. That stands for Modified Adjusted Gross Income. Now, why are those 2 years different? It's because Medicare actually uses a 2-year look-back period to determine the premiums that you pay for Medicare today. So it's kind of funny, but in 2023, the Medicare premium that you're paying now depends on what you earned in 2021. So they use that 2-year look back. So going back 2 years, if you are a single filer and you made under 97,000, you pay the lowest cost that you can for Medicare Part B, about $165 a month, plus whatever your plan premium is for Part D, if you have Part D. If you're a married couple, it's 194,000 or less. You'll pay the lowest rates on Medicare. Each of those are the monthly premiums. You can see as your income in 2021 starts to go up, the premiums that you pay in that third column for Part B also go up to a high of as much as $560 a month. So this is just a reminder that, the decisions that we make today about potentially recognizing more income for tax planning might impact your Medicare premiums. So we want to be aware of that too, not just the federal marginal rates and those brackets, but we also want to look at these IRMA brackets because it could affect your Medicare 2 years in the future, and we don't want to be hit with a surprise, high Medicare premium that we weren't expecting. So that's the first tax trap. The second tax trap to be aware of is the net investment income tax, or NIT for short, also based on your modified adjusted gross income. So if you are a married couple and you file jointly, if your modified adjusted gross income exceeds $250,000 this year, you'll be subject to that net investment income tax. And what that means is it's like a 3.8% surcharge on top of what any other investment taxes you may pay, capital gains tax or what have you. You'll be subject to this surcharge of another 3.8% if you're a high earner. So the 15% capital gains rate would go to 18.8 if you exceed any of these thresholds on the right there based on your filing status. So again, one more thing to be aware of if we decide to recognize more income in a certain year, you may end up paying more in investment taxes. And so that tax would be applied to pretty much any investment income. So it would apply to dividends, it would apply to interest payments from bonds, fixed income. It would apply to rent, royalty, and capital gains. So pretty much across the board, you may end up paying that surcharge if you're not aware of these NIT filing status threshold amounts. Okay, let's move on to another planning item that does have a 12/31 deadline, and that's tax loss harvesting. So you may be aware that you can often offset capital gains by capital losses if they're all realized in the same year. So the tax laws allow us to do that because you pay tax on the net gain. So you might have a lot of capital gains, but you also may have a lot of capital losses. And as long as you recognize everything in the same year, you could offset some or even all of your capital gains. So it's a really good idea right around now to see, well, what capital gains have I already recognized for 2023? Am I kind of on track for a big capital gains tax bill or not? And if you are, you might have an opportunity to look around your taxable investment accounts. These are your non-retirement accounts, and see, are there some losses that I have not recognized yet? Because if you sell them, you may be able to offset some of those gains. So that's the way the law works. Now, there's usually a greater opportunity for this strategy in a down market year. We're actually having an up market year in 2023, so losses might be a little harder to find. 2022, they were a lot easier to find. This year, you might have to search a little bit more, and of course, everyone's portfolio is going to be different. So you may or may not have those losses, but certainly want to look. And another wrinkle to the tax law is that if you actually recognize more losses than gains, which is possible, you can offset a little bit of ordinary income too, up to $3,000. And that's true for married couples or singles. And if you have more than a net $3,000 capital loss, you can even carry forward those losses to future years. So maybe one year you've got enormous losses, and you might be able to offset gains for many years to come. So it's a tax benefit that can really go on permanently because there's no limit to the number of years that you can carry forward those losses and offset future gains. Now, one thing to be aware of if you're going to think about executing this strategy, you have to sell the asset to recognize losses. But beware that if you buy that same asset anytime within a 60-day window that goes from 30 days before the sale to 30 days after the sale, the IRS is not going to allow you to recognize that loss. That's called a wash sale. And it's to avoid to prevent people basically from selling an asset only to save taxes. They don't want you selling something and then buying it back the next day or the next week. They consider that a wash sale. And so they disallow deductible losses if you do that. So you got to look at that 60-day window before you buy something, either the exact same or substantially the same. So one more rule to be aware of. So as I mentioned before, some planning items actually don't have a 12/31 deadline. Most of them do, but one of the ones that don't is contributing to a non-employer sponsored tax-deferred retirement account, like a traditional IRA or a Roth account or a SEP IRA. You can make those kinds of contributions often many months into the following year up until your tax deadline. Which is April 15th, 2024, for 2023 contributions. There is an earned income requirement. So note that in order to make contributions to these accounts, you need to have earned income. And that's typically either salary income or 1099 income. So not capital gains, dividends, or IRA distributions, not that kind of income. The limits in 2023 for IRA or Roth contribution, $6,500 plus $1,000 catch-up contribution if you're over age 50. The deadline for IRAs and Roths, as I mentioned, April 15th of next year. The SEP IRA can go a little longer. In case you have a filing extension, you may be able to go out as far as like October if you request and receive a tax filing extension. And as of January 1st, 2020, if you're over age 70 and a half, you can still make IRA contributions if you have earned income, if you want to. A common question that we get here at Elevate is, if I make a contribution to a traditional IRA, will that contribution be deductible? And that can be a complicated question to answer, because it actually depends on two factors. One is your adjusted gross income, and the other is your or your spouse's employer plan coverage. So the rules are all different, kind of depending on those two factors. If you're single and you're covered by an employer plan, the deduction amount is phased out at a fairly low income between $73,000 and $83,000 this year. So if you make more than $83,000 as a single person who is covered by an employer plan, you would not be able to deduct that contribution to an IRA. You could still make it, but you wouldn't be able to deduct it on your taxes. If you're married and you file jointly, if you, as the employee, are covered by an employer plan, your phase out range is a little bit higher, 116 to 136. And if you're not covered by an employer plan, but your spouse is, the AGI limit in that case for deductibility is 218 to 228 this year. If you are single but not covered by an employer, the phase out's 138 to 153. And if you want to be able to make a direct contribution to a Roth account, the phase out limit for singles is 138 to 153 this year, 218 to 228 for married couples. And again, those numbers, all the numbers really on this screen are indexed to inflation, so they tend to change every year. So all of these are the relevant numbers for 2023. We have some new changes as of the end of 2022, and that's what I'll focus on for these final two slides. There were some changes to the regulations for inherited non-spousal IRA beneficiaries that went into effect in 2020 and were revised in 2022. So any IRA that was inherited before 2020 are not affected by these rules. So for those IRAs that were inherited, again, non-spousal beneficiaries, there's no time limit on fully withdrawing from those older IRAs. And you do have to make required minimum distributions each year, but those distributions can be stretched over the lifetime of the beneficiary. So you may be able to stretch those out over many, many decades and not pay very much in taxes by stretching out those RMDs for as long as you can. So those older IRAs, again, not impacted by the rule change. Now, starting in 2020, non-spousal IRAs that were inherited after January 1st, 2020, they're now subject to two different withdrawal rules. The first one is the 10-year distribution rule, which means that account needs to be fully withdrawn by the end of the 10th year after inheriting. So they cannot last longer than 10 years. Also, the second rule is RMDs are required each year if the original owner was already subject to RMDs themselves. Now, the RMDs can still be based on the life expectancy of the beneficiary, so they can be low, but again, you're going to run into that 10-year distribution rule. So it might not make sense to wait until the end of that 10-year period, because then you're going to be hit with a big tax bill when you have to take out the whole thing at the end of the 10 years. But you still have to make at least minimum distributions each year based on the life expectancy of the beneficiary. Again, if the owner was already subject to required minimum distributions themselves. Now, there's been a lot of confusion on this rule, and the IRS just issued some clarification, some guidance on this in the last couple of months, and they are waiving any penalties or requirements for that RMD rule for this year and last year. So this doesn't start until 2024. So if you don't want to make a distribution from an inherited IRA this year, you don't have to, and you won't have to worry about penalties. So this doesn't start till next year. And finally, we have some new legislation, major new legislation that was passed at the very, very end of 2022. And it's referred to as Secure Act 2.0. The original Secure Act was from 2019. 3 years later, they revised it, added some things, updated it, and now we have Secure Act 2.0. Now, this was an even larger and more complicated set of new regulations, big piece of legislation. So I will definitely not be able to cover the full impact of this, but I'm just going to hit some highlights, some of the changes that I think might be most relevant to the people listening in on the webinar. So one of the big changes is there is now a new option for using funds in a 529 college savings plan. A lot of people, when they make contributions to 529s, they're not sure, what school their child is going to go to, how expensive it's going to be, and what will happen if we kind of overfund it and we don't use up all the balances. What's going to happen to that account? Well, Secure Act 2.0 provides another option for unused balances in a 529 plan, and that is it allows a rollover to a Roth account for the beneficiary. There's some limits on the ability to do this. Each year, you're still subject to the same Roth contribution amounts, which this year is $6,500. So you can't do more than that in a single year. There's a lifetime cap on that rollover of $35,000, and you have to have that account established for at least 15 years prior to doing that first rollover into a Roth account. Also, the last 5 years of contributions are not eligible for that rollover. So a bunch of things to keep in mind. There are also some changes to catch-up contributions. Right now, as we mentioned before, current law allows for workers over age 50 to contribute an additional amount to their retirement accounts, whether that's 401ks or 403bs or IRAs. It's $7,500 this year to their 401ks, 403bs, or an extra $1,000 to IRAs or Roths. if they're over age 50, that limit is going to increase substantially in 2025, but strangely, only for workers in a very narrow age category. So if you are going to be age 60, 61, 62, or 63 in 2025, you will have the option now of contributing quite a bit more to your retirement account if you want. They're going to raise that catch-up contribution to $10,000 or 150% of whatever the prevailing catch-up amount would have been, whichever is greater. So an opportunity to really kind of supercharge your savings there toward the end of your working time period before retirement. One other thing to keep in mind, if you are a high earner, and if you earn over 145,000 as an employee, those catch-up contributions are going to have to be directed to a Roth account or a Roth-like account. So they're going to be post-tax. So you won't be able to put those extra contributions into your deductible 401ks, although some new updates to that rule just came out, and they've now delayed it again due to some confusion and due to sort of the ability of employers to get ready for this in their systems. They've delayed that rule to 2026. So in 2025, you will still be able to make those contributions to your standard 401k accounts. And finally, there were some changes again to required minimum distribution starting ages for those people that own IRA accounts. If you right now, the rule, at least before this year, was the age started at 72. So if you were 72 or older, you had to start taking RMDs. But that was just changed to 73 for individuals born, who will turn 73 between January 1st of next year and the end of 2032 for that 8-year period, actually 9-year period. Your new starting age for RMDs is 73. So you get to delay it one more year. And if you turn 73 on or after January 1st of 2033, they've really increased your age, added a couple more years to make it 75. So that will be your starting age group if you are younger than 72 this year, or sorry, younger than 62. You'll get to delay that RMD starting age all the way to 75, which may be beneficial if you don't really need to take those distributions. Great. So we have reached the end of my prepared slides. I hope you enjoyed that. I hope that was useful, and I'm happy to take any questions. And I will stop the sharing and turn my camera back on now.
Thank you, Rob. As always, your comments and insight on this is always so detailed and informative. So thank you for that. Before we do wrap up, we do have a few questions that came in. So I want to make sure we get those answered. The first question is, were there any changes to spousal beneficiaries for inherited IRAs regarding the newly passed Secure Act 2.0?
Sure. There actually was one change for spousal. So in the presentation, I was referring mostly to non-spousal beneficiaries. But there is a change for spousal beneficiaries, which is you can now elect to be treated as though you are the deceased spouse, meaning that you can take RMDs from the inherited account as if you were your spouse who passed before you. And that can be beneficial if you happen to inherit an account from a younger spouse, because you could stretch those RMDs over a longer lifespan. So they have just added that option to be treated as the decedent in that case.
Okay, great. An additional question also came in, and this is relating to account types. This person has IRAs and a 401k, but their question is regarding Roth IRAs. What are the advantages, disadvantages, And are there any differences in the return on investment between those types of accounts? And then a follow-up question to that would be um, just a little bit more info on the Roth and how it might differ from individual stocks or other type of cash flow
Sure,
vehicles.
sure. So the big difference with Roth accounts is how they are treated under the tax law. So the investments can be exactly the same. You could hold the same kinds of investments in an IRA or a 401k or a Roth account. So there's really no difference there. So you can choose what you want to put in those accounts and how you want to fund that. But the difference is how they're treated under the tax law. So typically, if you make a contribution to an IRA account or a 401k or a 403b, you get to deduct that contribution off of your taxable income. So you can save a little bit on taxes by making those contributions in most cases. Whereas if you make a contribution to a Roth account, there's no immediate tax deduction. So that's not a tax deductible contribution. However, once the money is in the Roth account, it grows tax-free and withdraws from that account, after you've met the certain age requirements, are tax-free. So that's kind of the opposite of how an IRA works. An IRA, you get the tax benefit at the beginning, but you pay taxes as if it were ordinary income when you make withdrawals. Roth account's kind of the opposite. No immediate tax benefit, but you get all the tax benefit at the end because you can make withdrawals and not have to pay taxes on those withdrawals.
Right. Okay. Great. Um, that looks like all the questions that we have for today. But if you do have additional questions after the session today, or would like a copy of the 2023 financial planning checklist, please email marketing@elevate-wealth.com and we can get that over to you. Just want to thank you so much for joining us today. Be sure to sign up for future webinars on our website at elevate-wealth.com. And also for more financial tips, follow us on our YouTube channel. Simply go to youtube.com and search for Elevate Wealth Advisory, Athens, Georgia. Thank you so much for attending today, and we hope everyone has a wonderful fall.
Yes, thanks very much. Bye.